Welcome back to another Meet Kevin Report. It is episode 126. It's July 19th. Still got that amazing, beautiful, sexy newsletter that goes out daily. Link down below in the YouTube description. And make sure to sign up for that great email newsletter. I used to not be into those, but the amount of positive feedback we're getting into those has been extremely motivating. So I love the positive feedback from y'all. Thank you so much for that. Today is obviously Tesla earnings a day, and I'd actually like to start with a mention of something very interesting about Tesla. Look, a lot of people are putting up earnings estimates, and we'll look at a few of these. What I think is most fascinating, though, is actually positioning. Positioning is probably the most important as well. So there's a piece here by Bank of America Securities, and it talks briefly about Tesla positioning. They start off by talking about tech in a bubble and how high will tech basically go. And the gist of their piece on big tech before we talk about Tesla is really just that, yes, the S&P 500, excluding those top 7 companies in the S&P 500, is valued at just 15 times earnings. But if you factor in those top 7, those top 7 that are trading for 40 times earnings, then the entire S&P valuation goes up to about 18, 19. Point is that a bubble, right? Are these ultra techs a bubble? And the argument by Bank of America Securities ends up that, well, it's really these mega caps or ultra caps at this point that are just deemed the safest to be in, but not only the safest, but they're deemed to be those with the most amount of cash and the most amount of profit potential. So maybe this is more of a case of the rich get richer than it is a case of some kind of a bubble bursting. Now, what is wild about that is actually the very last page of this. Take a look at this. Just Apple and Tesla are underweight out of the 7. So in other words, these funds, larger investment funds or whatever, that have moved into these mega cap stocks so heavily this year so far are mostly allocated or overweight to Microsoft, Amazon, Google, Nvidia, the other voting class shares of Google, and Facebook. But they're actually underweight Apple and Tesla. Now, that I think is very interesting because this could lead to floors under, and this is my thesis, but could lead to floors under pricing for Apple and Tesla. In other words, weak earnings at Apple and Tesla could be seen as a short-term opportunity to get back to overweight in these 2 stocks to catch up to the investments being made into the Microsoft, Amazon, Google, Nvidia, and Facebook. That's a thesis that I have. We're not necessarily always going to be able to say that, bad earnings is always going to get caught up with dip buying, but it does seem to be that there's a lot of money on the sidelines, whether it's from fund managers or individual retail looking for an opportunity to buy the dip. Usually Tesla earnings lead Tesla stock to go negative. And I do think it's very interesting that on the morning of Tesla earnings, you have Tesla actually trading up about 0.7% in pre-market trading, especially since usually Tesla goes negative after earnings. So pay attention to that. But this underweight positioning by institutions of Tesla and Apple could be a good tailwind for Tesla and Apple. I'm honestly surprised that Apple was somewhat underweight as well relative to some of these others here. But oh well. and it's also worth noting the number of funds, not just the positioning of underweight versus overweight, but also the actual positioning. If you do own Apple, or rather I should say not relative to the being underweight, overweight. Let me rephrase that. Somewhere still around 70% of funds do have exposure to Apple, but it's a nominal exposure. So that's what's worth noting is the level of exposure for Apple is high. Like a lot of people have a little bit of Apple, but it's underweight compared to even the S&P 500. As you can see, Apple positioning is only sitting at about 0.6, whereas the S&P 500 would put you at a substantially higher positioning. And funds actually have a higher positioning to Microsoft, Amazon, Google, Nvidia, Meta than they do to the S&P 500. But only about somewhere 32-ish, 35-ish% of funds actually have exposure to Tesla. It's all alone over there in that corner. Wild. Now, regarding some estimates, I'd love to see Troy's estimates on Twitter. I think he does a great job. His estimates here versus consensus are that we're looking for an 80-cent non-GAAP EPS. I personally don't love using non-GAAP. Let me just quickly remind you what non-GAAP is. Non-GAAP is, and every company is different with this, so I'm painting with a big brush here, but non-GAAP is basically a beautiful way to say, hey, stock-based comp is a non-cash expense, so we're going to pretend like we didn't spend any stock-based compensation money. So if we say we spent $200 million on stock-based comp, we're just going to come up with this new figure called non-GAAP EPS that won't be associated with our stock-based comp and evaluate based on that, which I think clearly understates your compensation expenses. This is why usually your GAAP EPS is lower. So to be exact, the adjusted or non-GAAP EPS for Tesla is expected to be 80.9% to be perfect. Tesla has beat on that number 5 out of 8 of the last earnings. For EPS GAAP, we're looking for 71.1 cents. They've beaten on that number 6 out of 8 times. On revenue, Tesla has beat 5 out of 8 times. We're looking for 24.5 billion. And on net income, they've beaten 7 out of 8 times, which is good that you have this history of beating sort of on a margin POV. And we're looking for 2.87 billion. So I would write those numbers down. I also think it's interesting that the average movement for Tesla stock is 7.14%, but the implied movement over the next 24 hours is only 6.48%, which is lower than what you would have expected. So let's go back for a moment to Troy's calc. So we got some more detail here on the Wall Street consensus. His thinking is that Wall Street's margin estimate is going to be 18.2. He thinks they're actually going to come in with a 17.3. I do think the big two risks for Tesla are not only you getting this margin miss from Wall Street expectations, because that, unfortunately, that a margin miss is going to lead to future write-downs of earnings. Not great, but that could be offset by what's said in the earnings call. So it's always possible that the first minute you get some kind of large sell-off, and then maybe that gets talked up again in the earnings call. Though I don't know. Usually I'm not so knock on wood optimistic about post earnings, but I've never really found Tesla or trading earnings to be super beneficial, since sometimes you end up getting to a 3-week rally soon after you get earnings, and then all of a sudden you miss out because you're like, oh crap, I forgot to buy back in. Trading earnings is really difficult, so I'm not selling. So what else do we have? We've got Nissan announced the Tesla. They're adopting the Tesla charging adapter as well. You've got a little bit of news that Tesla is converting a movie theater, I think it was in LA, into some kind of delivery and service center hub, which is great because the more service centers we've got available, the easier it is for new customers to get their problems dealt with. Personally, I haven't had a lot of problems with Teslas lately, but I will say when I first got my Tesla back in 2017, there were a lot of problems, and having more service centers around is nice, especially when you have the mobile service centers. Some areas just don't have mobile service availability, so the more they can expand that service, the more people can say nice and positive things about Tesla. So overall, look, whatever happens today for Tesla earnings, obviously, it's going to be very closely watched. I'll be covering it live, so make sure you're there. But this underweight right here, buy funds for Tesla, could flip. And this is where I actually like to go most optimistic. And I realize this is probably a little biased, but I want to put it this way. I think that once Tesla, and I'm going to write this down because I didn't want it to be forgotten. Once Tesla proves it can survive this recession, which I know most of us who invest in Tesla are looking at it going, what do you mean, Kevin? Of course they're going to survive this recession. Yes, we know that. But once Tesla proves to the rest of these these underweight funds. So I'm going to write this to the underweight funds that not only can it survive this recession, but also still generate incredible above industry average margins and beyond. Because really, industry margins suck anyway, right? Margins suck anyway, though. I like to say that industry margins suck anyway. I mean, GM's decent, except for their EV business. They lose money on EVs. They don't expect to make money on electric vehicles until like 2025. But for their legacy biz, they're somewhere around 13% gross profit. And, Ford is a little less than that, but still decent, excluding electric vehicles. They don't expect to make money on electric vehicles until 26 or something stupid like that. But anywho, once I believe that Tesla proves, look, we're going to get through the hard time. We're going to get through the potential, we're going to survive the capital needs, right? This is stock. This is basically a money raise, and survive the margin, or I should say, hit the margin trough, which is hitting the floor, right? And then we start moving up again and move up again. This is really when I think you're going to start getting those underweight funds actually moving into Tesla. So a lot of people have been wondering, like, hey, when would I really in earnest be interested in, not just like from a rebalance point of view, but cutting Tesla and selling Tesla and moving into whether it's real estate or something else? Well, it's really when funds get euphoric. That's when trim time comes. And we're nowhere close to that. So I know the stock has obviously moved from 105 or whatever to 290s, but really that just puts you back to where you were in March of last year. So you really haven't done anything if you look at it from a year-over-year point of view. So euphoria wasn't there then. It isn't here now. And in my opinion, that actually gives you a floor for bad news, as much as there could be a little rubber band to the downside, but it gives you a really optimistic path forward. Those are my takes. Now, we'll see. We'll see what ends up happening. Tesla should just acquire Enphase. They probably wouldn't do that, mostly because they create their own inverters. And they use string inverters, which are a cheaper way of conducting solar installs. Well, the microinverter people say that, so that's a little biased. But it's very unlikely that you would see that when they've they acquired Solar City, right? So you're acquiring the string inverter strat, which is okay. At what point is Tesla overpriced? Well, that's going to depend on where that trough in margin is and where the trajectory is of where it ends up going. So, if Tesla caps out at a 20% margin, maybe euphoric is 350, 375. If Tesla goes back to its 30% margin direction, maybe euphoric is more like $500, $600. Who knows? It could even be much higher than that. So we'll have to see. Anyway, some thoughts on Tesla. So buckle up today. But this underweight positioning, something I haven't seen talked about, and makes me very excited. So we'll see. Because the more you get institutions transitioning, the more you actually get positive analyst pieces written as well, as opposed to all the bear pieces that get written about FSD and all that nonsense, which you really have to drive FSD to understand it. Somebody has negative comments about FSD and they haven't actually tried it. Probably not the best resource to consider opinions from. Anywho, as always, remember to check out the programs on Building Your Wealth link down below. Next coupon expiration is a week from today for Fed Day. And as always, not only do we always add more content, but we do fundy analysis every single day the market is open on stocks that you're looking at or I'm looking at or earnings calls or whatever. Really great for looking for value opportunities or understanding how the market functions, learning about where opportunities are, much more. Not only that, but then, of course, we've got the real estate analysis and one of the most popular ones right now, how to make more money and get SH90 done faster, featuring AI to really get you from zero to, oh, wow, I can actually use AI productively on a daily basis. Good. Now, that is the Tesla intro. All right, we're going to call that the Tesla intro. Okay, wow, we're already 14 minutes and 50 seconds in. So, market is slightly green going into the Well, I mean, we're down a point on the Dow and the S&P. Nasdaq's up 16 basis points. I love this collapse in the 10-year Treasury, though. The 10-year Treasury down to 3.73, call it 3.74. So good to see this coming down off of the 4.08 that we've seen. We did also just get some housing numbers. Maybe jump into housing. So let's see here. All right. Okay. Well, it's kind of boring. Yeah. That's actually interesting. Okay. Anyway, so let's talk housing numbers and some of the housing numbers that we just got. First, you have to understand two differences. There's a start, and then there's a permit. So usually permits are measured by applications. Remember that in order to get to an application, it takes time to get to this point, right? You've got to create your architectural diagrams of what you're wanting to build. Then you go to the building and safety department and you go apply for those permits. Then that permit review process could take 3 months, 6 months, a year, 2 years, depending on where you are, right? A start would be like pouring the foundation. This is your colloquial breaking ground on actual construction, right? So keep that in mind. I know sometimes it's a little confusing when we hear this because it's like, oh, is permit like permit issued or app? Where are we? Whatever. So what did we actually get in numbers today? Well, we got housing starts were expected to come in at 1.48 millis. They actually came in lower than expected. So starts lower than expected. This is quite interesting, especially since there's been so much talk about builders wanting to take advantage of low inventory. So starts lower than expected at 1.434 million, and also a down revision of the prior by somewhere around 80,000 starts. So previous hot report really down revised. And building permits also soft at 1.44 milli versus the 1.5 expected. Housing starts coming in at a negative 8%. The expectation for June, the expectation was negative 9.3%. And building permits, those are month-over-month figures, by the way. So really, that's a pretty decent slowdown there on starts. Building permits coming in at negative 3.7% versus the positive 0.2% expected. So if you're looking for relief on inventory from construction over the next 2 years, unlikely to see relief from inventory from construction, at least not as rapidly as people are hoping for. It's probably a sign that home builders are prioritizing profit over let's print as much as possible. And when I say print, I mean build as many houses as possible. Now, when it comes to myself and what we're looking for as a company for real estate investments, I'm starting to find that finally in certain areas, we're starting to see some more inventory come on the market. And while there's always competition for real estate, I actually think that's a very natural thing. You should always expect multiple offers. Like people say that like it's a scary thing. But let me tell you this, if you're looking at a good deal and there are no multiple offers, you're probably not looking at a good deal unless you're the only one who knows about it. So it's okay. You can compete with other offers. It's not a big deal. But the point is, as inventory slowly starts to hopefully build up as we get into the second half of the year, I do think there'll be some opportunities for a lot of folks who are on the sidelines to potentially buy. But a lot of other people will be constrained by affordability. And that actually is a very unique opportunity to buy because think about it. If you have slightly elevated inventory, but less potential available buyers, you're going to be able to likely price in some better deals. Now, of course, the housing numbers today suggest that time frame where we have elevated inventory, hopefully and when I say elevated, I mean like historical norms, it's still low, right? Elevated compared to now. So a little bit more inventory compared to now and higher rates, which puts less buying pressure out there, does create more opportunities potentially for longer if it takes even longer for rates to normalize. And ultimately, a lot more inventory to come in the market from home builders. I know that's a little bit of a give and take on both sides, but that's something that we're expecting because that build phase drawing out even more inventory coming out while rates are higher for longer, I think could create this weird environment where potentially pricing is relatively flat for the next year or two, which is great because it just gives you time to buy. And I think that's what a lot of people are looking for. I don't think we're going back to real estate euphoria, at least for a few years until we get everything back into balance. Again, great opportunity to take your time and build some fantastic foundations in real estate. I did also notice that when you look at real estate inventory over the past decades, you have this very interesting trend of declining inventory. So if you go back to, I think it was the St. Louis Fred had a piece on this, and you go back to, oh, let's see, housing inventory. Yeah, okay, here's, that's just California. I'm going to go, let me see if I can get the entire United States. There we go. Monthly supply of homes is predicated based on what you have from how many buyers you have as well. So not a great number. There we go. Active listing count in the United States. That's better. Yeah, it's still not great. But anyway, somewhere, and this is just a little taste of it, but somewhere I found a beautiful chart that went all the way back to the 80s. And just pay attention to this pre-COVID section right here, pre-COVID. You see this downtrend, this slight downtrend of housing inventory pre-COVID? This downtrend has happened since the 80s. And I don't know if it's just that houses stay on the market for a shorter period of time because of the internet, apps, how quickly people are able to communicate, how quickly people are able to get pre-approved. I'm not sure, but there's some kind of long-term transition to, look, houses just stay on the market last long. I remember when I got into the industry in 2010, people would come to me and say, all right, I'm looking for a 3-bedroom, 2-bath below the mall, close to the mall. And I'd be like, all right, here are 20 houses to look at. And, somewhere by like 2014, 2015, that turned into, all right, that's cool. You're looking for a house below the mall. I'll call you when one's available. It's a totally different environment. So I find that very interesting as well. Things move a lot quicker nowadays, and it makes sense from an internet point of view, right? So a lot of these things I think are very logical. And I find them to be, once we understand the logic of them, I find them to be certainly less intimidating than I think people point them out to be, and quite frankly optimistic for sort of a breather of the insane real estate appreciation that we've seen over the last really 13 years, and an opportunity to really build some good foundations over the next 2, 3, 4 years, and then you'll probably end up going back to zero to negative interest rate policies, which will just end up jerking up real estate prices in the long term very well. Now, I did think it's very interesting that I saw a tweet yesterday. Peter Schiff's son argued that he is flipping on Bitcoin now because he's arguing that we're going to fall into a deflationary boom. And I thought that was remarkable. And I actually think generally very highly of Peter Schiff, his family, and his son, and their POVs. But I was thinking about that a little bit, and I'm like, wow, is it actually possible that we could fall into a deflationary, cycle or deflationary economy? And my reaction, which I still believe in, is no. I do not think it's possible that we fall into deflation. And this ends up having really big implications, by the way, for investing in real estate or stocks. So I really want you to think about what I'm saying here. Why would we not fall into a deflationary boom? Well, deflationary booms, where you're essentially growing the market share of larger companies, and at the same time reducing prices, generally leads to the rich get substantially richer via the companies that take market share, and you end up getting a lack of interest in people spending, and you hurt debtors. The reason you get a lack of interest in spending, even though people are still going to spend, is because you can be patient and you can just wait to buy because prices won't go up. And second of all, it hurts people who take on debt, and your big debtors are usually your manufacturers, which are your job providers. And so this is a bad situation to be in. You concentrate your availability of companies, that is very punishing to companies. You delay GDP spend, which is not great, and you hurt debtors like manufacturing. We should enjoy deflation because everybody should be interested in having less debt and having a more balanced fiscal house and declining prices. You would want a deflationary environment. So we are technically supposed to want deflation. But I don't think we'll ever actually get it. And that's because I think as soon as we trend towards deflation, we will essentially give modern governments the license to print as much money as they want. And guess what that's actually going to do? It's going to do very well, in my opinion, for your stocks and for your real estate, because stocks and real estate will become your true inflation hedges, mostly because it doesn't matter what currency you denominate a share of a company in or a share of real estate in. It doesn't matter if I'm selling it to you in loaves of bread, some kind of post-apocalyptic currency, or dollars or euros or whatever. It doesn't matter. The value will be appraised based on whatever its actual function and value is. The actual currency denomination doesn't matter. So stocks or real estate, therefore, are a fantastic hedge against this. And because I would expect rapid returns to zero interest rate policies or negative interest rate policies, nicknamed ZERP or NERP, I think the best place to be for the next, decades really here, until the next big old crash that we end up walking into, will be stocks and real estate. And we're nowhere near the next big crash, in my opinion. So all of this is really to say that, of course, check out the programs on Building Your Wealth link down below and the perspectives on going from zero to millionaire in real estate, or the stocks and psychology of money, or how to make more money and get SH9T done faster with AI link down below. But what it's really to say is there's an opportunity to build foundations right now, in my opinion, where you allocate pretty heavily to stocks and real estate. Ideally, you balance your allocation to these, right? You want to be exposed to real estate. You want to be exposed to stocks. I don't actually put bonds in that equation. I think real estate is a much better tool than bonds. My take. So stocks and real estate, you allocate heavily to these. The next few years, I think you still have, compared to the euphoric days, relatively reasonable stock valuations and a pause of real estate insanity. And those create opportunities to buy. Set yourself up over the next few years to get in as much as you can. And when we return to ZERP and NERP, it's when you sit back with your Mai Tai and you go, well, damn, aren't I glad I allocated? Now, of course, if you walk into, a near-term recession, maybe that's less desirable. But even when we look at the near-term recession potential, I think one of the easiest, and this is the kind of stuff we like to do on a daily basis, even though it's not as much of something that stands alone, it's a perfect thing to talk about here. It's the JP Morgan earnings. Phenomenal, by the way. But I want you to see their comments about a recession. So their comments on recession, which directly relate to what I'm discussing here, are the following. We're trying to be really clear here. The consumer is in good shape. They're spending down their excess cash. That's all. Tailwinds. If we go into recession, we're going in with rather good condition, low borrowings, and good price to value, but the headwinds are still substantial and somewhat unprecedented. So in other words, a way of saying, look, yes, there could absolutely be a recession, but at least based on what Jamie Dimon believes, it'll probably be either we'll be looking at a soft landing or some kind of mild, relatively nominal recession. And this is fantastic. And really, when we go through the JPM earnings call and some of the details, they reiterate to us why it makes sense to allocate to stocks or to real estate, mostly because, as they've mentioned here, quote, consumers have absorbed the late cycle a lot better than we expected a year ago. In other words, consumers are surviving. So really talking up the potential of a soft landing now. It used to be that a soft landing was the Goldilocks scenario, where basically you have to be an idiot to believe in it. I remember people made fun of me on this. I went, if you type in, I'm pretty sure if you type into YouTube, Meet Kevin, Yahoo Finance, Goldilocks, you'll see a lot of people making fun of me in the comments on this video from, I think, the beginning of the year or the end of the year, end of last year, saying, yeah, like, I think it's entirely possible we're heading into a Goldilocks scenario. And everybody's just railing on me and making fun of me, like, there's no way, there's no way. Uh, and, here we are. Now you have JPM and these other company or other institutions saying, no, yeah, that could actually be exactly what ends up happening. So who knows, obviously, but this is obviously quite exciting if you are allocated. And I think for the long term, it's very difficult to argue against stocks and real estate. Bonds, on the other hand, you've got some fantastic yields right now, but unfortunately, I think those yields are coupled with some larger opportunity costs. Because think about it. I know a lot of people say, okay, well, why would I take 4% on real estate or 5% on real estate if I can get 4 or 5% on a 10 or 2-year bond right now on treasuries? And the argument is, well, future leverage depreciation, and depreciation benefits for taxes, but then also the opportunity to exchange real estate, which you can't exchange bonds. You're paying taxes on those, which you might not be in the future on real estate. So there's some, in addition to future liquidity opportunities for real estate financing that are, not taxable events like refinancing. These are all opportunities in real estate that the bonds just don't have. So not only that, but that's comparing bonds to real estate now at 4 or 5% for bonds. When bonds go back to their usual 1.2 to 1.5 to maybe 2%, real estate then looks very desirable again. But I don't necessarily want to buy real estate heavily when everybody thinks real estate is desirable. I want to buy real estate when people think real estate is not desirable, which reminds me, we are still expecting an August start to our money raise for House Hack. So if you're curious about that, my real estate startup is expected to do the non-accredited round, which means anybody can invest. Might even be able to invest with a credit card, which would be pretty crazy. But we'll see. But we would expect that to be possible within the next hopefully 30 to 40 days here. We're really, really close now, closer than we've been in quite a while. So we're pretty excited about that. Anyway, these are some of my thoughts on real estate. So there you have it. The real estate thought and the housing thought. All right. Next. All right. So next. It is 32:51 minutes in already. All right. So what else do we have? Let's see here. I wanted to take a look at, there's Goldman and Carvana we can touch on. There's quite a bit we can touch on, so let's touch on a little bit more. But let's take a brief look here at what we've got for Goldman. So let me write this down. All right, so here's a catch-up on Goldman. Plunging profit means Goldman just had one of its worst quarters since their new CEO took over. There wasn't one reason why earnings fell 58%, because everything got hit. Investment banking slumped, real estate markdown, consumer division had goodwill write-downs. 4% return on equity was among the worst for U.S. banks. Some notes of optimism about continued strategic execution of goals and remaining confident in the firm. But overall, despite shares being relatively flat, the actual earnings report didn't seem to be that fantastic. Nice write-down in warehouse and other indirect real estate, making up the larger share of the commercial real estate write-down. A lot of, obviously, office and commercial real estate write-downs. Surprising these banking earnings, although they shouldn't really come as much of a surprise because that's your sort of weak portion of real estate right now. So find that somewhat interesting. Then let's jump over. So that's a pretty short and easy discussion there. Let's jump over briefly into what's going on with Carvana, which is somewhat of it's an unsurprising surprise to me, and I'll explain why it's a surprise, but also why part of it is unsurprising. All right. So obviously, we know that Carvana is doing some wild things here in pre-market, and probably will continue to do some wild things as the market opens, which we'll talk about those in a moment. But a lot of it has to do with the success of actually reaching a debt restructuring deal and selling potentially up to $1 billion of shares on the stock market. Now, usually, and this is the part that blows my mind, usually when companies issue shares after their stocks have rallied, their stocks plummet. But in this case, after Carvana has issued the desire to sell $1 billion of shares, their stocks in pre-market, their stock market is up 33%. Now, why? Well, it has to do with the debt restructuring. And that's sort of the unsurprising part. It's not surprising that a company like this is going to raise money, but the fact that they're able to restructure some of their old debt and eliminate 83% of their 2025 debt and their 2027 unsecured notes and lower their interest expenses by $430 million per year for the next 2 years is what's leading to this desirability of this restructuring for Carvana. So congratulations to them. I was really expecting that after some kind of momentum rally, there's no way they would have had the ability to negotiate with bondholders like that. I thought, okay, look, you get a momentum rally, you're going to issue new stocks for sale, and that'll end up putting downward pressure on the stock. That'll let you refinance your bond obligations, and fantastic, you're done. Instead, what ended up happening? The bondholders got burned to the tune of, 83% of their debt being written off, 2025 and 2027 unsecured notes, saving a massive load of interest for Carvana, and basically having a substantially larger impact to the stock than the positive impact, than the negative impact of a $1 billion raise. Because a $1 billion raise on a $7.5 billion company, it's about 13%. So you would have expected some downweight there, but that write-down clearly outweighed that. So congratulations to Carvana. Again, expected to see a raise, not expected to see an 83% write-down on the unsecureds. But congratulations. I mean, that's some good negotiating there, and they needed that because their interest expense was insane. So congratulations to those who took the YOLO on that one, because that one's done exceptionally well. So, all right, that gives us a little bit of a background on what's going on with Carvana. Although, I suppose we can. That doesn't make so much sense to look at their filing. Maybe after their next earnings, we'll go through their filing again. Now things have to do some adjusting to those bonds. But you know what? I kind of am curious. Carvana Investor Relations. Let's do a quick peek at it anyway. So if I go to their last quarterly result, let me just get a press release here. I don't need to go super detailed here. Third quarter, we're going to be here at July 19th. Oh, okay. So we just got earnings. Did this just come out this morning? Oh, it did. Oh, I didn't know that. Oh, okay. Well, we have a new press release and earnings this morning. Oh, well, fantastic. Let's look at it. They did that with earnings. All right. Let's take a look at what we got. Very interesting. So here's Carvana. So what do we have? You have a total gross profit per unit. Wow, back to $6,520. That is bullish for autos. That's fantastic. Wow, what a reversal there in autos. This is the only financial chart that they're providing right now until the 10Q is filed. It's a little disappointing, but I'd like to have a cash flow statement and a balance sheet, but they only gave us an income statement on their press release. Let me see if they have a separate here for financial statements. Earnings press release, supplemental financial tables. Okay, it's probably in here then. Oh, yeah. Okay, here we go. The financials are the most important to me. Yeah, so usually you're going to get a quarterly report that gets filed with the SEC a few days after these filings come out. So I'm generally looking for cash flow. It doesn't even look like we're going to get a cash flow statement here. No, we're not. But we do get a little bit of a breakdown of some of the income and expenses here. So net loss at Carvana, is the lowest it's been in any of these reporting periods here. $105 million. We are for the 3 months ended June 30th. The interest expense is at 155 per quarter, but 155 per quarter annualizes to 620. They just wrote down what we say like 480. So, their interest expense is going to drop by 77%. So a negative 77% is coming to that interest expense, which is fantastic because actually, if you take off 77% of that, you'd probably be profitable, right? Times 77%, take off 120. So your interest expense would be about 35 mil. No, because we have a net loss here anyway. So you have a net loss at the company anyway, so you'd still be negative, just be less negative. So interest expense would be negative 35. Not negative. Interest expense would be 35 mil. And then you'd get to, let's see here. Total revs, net loss margin, gross profit, 499. It's just a bizarre presentation that they have here. So, wait, net loss is showing us. It's very bizarre, the presentation they have here. But anyway, this is going to make a big difference, their interest expense. If I could get a better income statement than this non-GAAP nonsense that they're providing here, we'd have a little bit more color. So I think going through their 10Q when it comes out will be pretty useful for Carvana. But probably not a company that I'd still be interested in touching. But boy, congratulations to Carvana. It gives us a little bit of color of what's going on here. That interest expense was really whacking them. Okay, then next up we have, let's see here, next pieces. Okie dokie. So that's Carvana. Let's get to 42 min in. Oh, this China piece was fantastic. Let's do a quick look at this Chinese piece. Right. Okay, so here we go. A lot of folks looking to buy the dip on China, and here's a TS Lombard piece on why that could actually be a terrible idea. And I think this is very interesting. A lot of folks are anticipating massive stimulus from China, right? The expectation is that China would pull off something much like America, which is weakness, no problem. Let's stimulate. Reality, let's stimulate barely. And why could that potentially be? Well, TS Lombard has a little bit of a dirty expectation for that. So let's go through some of what they're arguing here. So first, judging by the media hype coming out of Beijing these days, authorities still believe that gullible investors can be induced to invest in China, despite the risk that a serious economic slump is just around the corner in China. This is true. You have a lot of folks who go on to Bloomberg or CNBC conducting interviews. I see it every single day. And they're like, well, we think we should buy the dip on China because they're at the bottom. Maybe they are. Problem is, for many of us not in China, it's very difficult to get a real clear understanding of what's actually happening in China. But what T.S. Lombard suggests is the following: that China really just charades the idea of supporting their economy, that they don't actually really care as much about supporting the economy as they say. And when they support the economy, they'll cherry pick corporate welfare over individual consumer support. And some of the reasoning for that could be because of the way the Communist Party likes to hold on to power. During his first 2 terms in office, Xi Jinping paid little attention to the economy, while he focused on strengthening his position within the party hierarchy, aiming for unlimited control at the top of the party. And that the goal for these companies is enshrining leadership rather than or with the party in private enterprises, rather than solely focusing on capitalism. In English, let's do a quick little translate here. T.S. Lombard is alleging, it's their allegation, right, They're alleging that China is one of those places where you might go and say, oh, we'll buy the dip on China because it'll be like America, where when they stimulate, everything will boom again. T.S. Lombard is countering this and saying, no, it's unlikely that you're going to see that booming type of stimulus. Why? Because instead, China does not necessarily want to prop up private companies too heavily, because a true, strong capitalistic system could end up leading to the removal or the end of the Chinese Communist Party. As those private firms get more power, have more power with the control of their labor, and have less Chinese leadership involved in them as the companies become more self-sustaining rather than reliant on the stimulative nipples, so to speak, of the Chinese Communist Party, then what do you end up with? You end up with more Chinese control and potentially weaker investment opportunities and investors who get burned. Think about that slightly differently for a moment. Let's draw this out, okay? Watch this. If the consumer is strong, what does the consumer do? The consumer votes for the best product or service. We frequently still in econ refer to this as gas, goods and services, right? Okay. The consumer votes for the best good or service with their money, and the companies that get the most votes, aka money, have the most power. Think Microsoft, Apple, Tesla, Nvidia, Meta, right? Some, Google. These are your most powerful companies here in America. So this is a consumer-led, stimulus. This is what consumer-led stimulus does. So consumer-led stimulus also leads to stimulating politicians getting votes, right? Okay. This is very much in contrast, there we go, to the Chinese strategy, Chinese corporate-led strategy. And I think this really goes along with what T.S. Lombard is saying. But what's the Chinese corporate-led strategy? We'll stimulate select businesses who give our party leaders board seats or control. Now you ingrain support for the CCP in companies, and companies care potentially more about CCP first. They're still obviously going to care about their consumers, but they're going to care more about pleasing the CCP first than they do about consumers, because it's not consumers receiving the shimmies. Yeah, same thing. Stimmies. Very interesting. It is so the opposite of America and even Europe or even other countries around the world. So that's something to consider. Let's look at a little bit more over here. None of this should install confidence in investors that Xi Jinping has a plan to address the growing laundry list of ills that Chinese markets and the economy are facing. The reason why Xi will not pivot to address the economy's ills via reforms is simple. He doesn't trust the reform. This is not because reforms don't help the economy, but because they undermine party discipline, fuel corruption, and encourage greater independence of local party cadres from central control. In other words, again, you stimulate the consumer, you get more local control, you get spread out control, you get consumer-led control, as opposed to top-down party-led control. Now, this is interesting because, this is not, really what this is to say is a prospering economy at all levels undermines the party from the top level. Find that quite interesting. It feels backwards, because you'd think, a prospering economy would mean more votes for the party. But if the party has unlimited control anyway, then a prospering economy just gives people money and options to have their own power plays and conduct their own reforms. So very anti-CCP doc here on, hey, a warning almost, so to speak, of don't invest in the Chinese dip. Emerging markets face a growing risk that central banks will over-tighten. Now, this gets into sort of other areas here. for over-tightening. What do we have here? China's slowdown will likely deepen further before stabilizing in Q4 2023. US, China, okay, so maybe there's your buy the dip time, unless this stuff makes you nervous, which it does to me. This is why I prefer, if I'm going to invest in China, I'm going to do so with NVIDIA or Tesla or Apple, the American companies. You get the American consumer still driving control. But it is worth noting China remains the only major economy, I guess supposedly outside of Japan, easing monetary policy, but still those party-led fears by T.S. Lombard. Quite interesting. Much like the courses on building your wealth link down below are interesting. So hopefully that's some good insight into China. Make sure to check out the programs on building your wealth before next week, Wednesday. We'll have the largest price increase that we've had so far this year coming up at the end of the day this Wednesday. So join. You get access to the new lectures, course member live streams daily, fundamental analysis. Beautiful thing is you could just dive in and search for a ticker symbol as well in our live streams and get a fundamental analysis on probably the companies that either you're interested in or investing in, or we just continue to do new analysis on a daily basis. So it's really fun. Hope to see you there. Not just that, but we talk real estate fundamentals as well. And then, of course, how to make more money, whether that's being an entrepreneur or an employee. So check those out. Linked down below. Big price increase week from today. Email us at staff@meetkevin.com if you've got questions. Good. So this gives us a little bit of insight into China. And let's see here. We're at 51. There we go. All righty here. So I don't know. Do we really want to get into talking about Trump? Let's see. Only 1% of U.S. homes turned over compared to the usual 3%. Morgan Stanley joins other banks in rush to raise fresh capital. NASDAQ halts plan to launch crypto custodian business. Yeah, probably because the SEC wants to keep exchanges separate. Let's see here. More time for Microsoft to close their $69 billion Activision Blizzard deal. Boy, that arbitrage closed so fast. So basically the valuation of Activision shot up after the judge denied the Federal Trade Commission's opportunity to block that merger. But honestly, I mean, some of the reasons for blocking that merger were a little loony anyway, so it's probably the right thing. Okie dokie. What else? Let's see what we have over right here. What's here?
And they're aimed at protecting competition, they say, in the modern economy. One of the guidelines is, quote, when a merger involves a multi-sided platform, the agencies examine competition between platforms on a platform or to displace a platform. Here's Assistant Attorney General for Antitrust Jonathan Kanter on Squawk Box explaining a bit of what that means a short time ago.
I can't comment on any specific case, but we have great faith in our court system, and it's there for a reason. We have the burden to bring cases before courts and convince courts that a merger may substantially lessen competition or tend to create a monopoly. And that's exactly why we've constructed these guidelines to build around the same precedents that courts are applying. To us, that is the best way to be faithful to the law.
Of course, the question continues to be, you can bring the guidelines, you can say you're being faithful to the law, Jim, but it doesn't mean that a court and a judge are not going to see the law perhaps in a bit of a different way. And we certainly saw that in the case of the FTC versus Microsoft, where that was completely thrown out by Judge Corley, and even the Ninth District was unwilling to give them a stay in terms of their potential appeal.
And to be fair, Bobby Kotick has been saying the same thing all along. He's been saying that when they get to court, the truth will out. Now, yes. David, page 18 and page 28 of this document are rather extraordinary. This is the document with Lena Khan and Attorney General Kanter. Number 7, mergers should not entrench or extend a dominant position. I cannot think of a single merger that's ever been done in our history of our nation that did not try to entrench or extend a dominant position. On page 28, mergers should not otherwise substantially lessen competition. I cannot think of one that would.
Boring. Take a look at this. The Wall Street Journal has the latest put call ratio out, which I suppose we could pull up at any point. But it's what's interesting about it now is the following. Look at this. Well, this is the University of Michigan Equity Index. Then, yeah, you got some meme stock rallies. Got it. What's this? Look at this. Look at the put call ratio. We are now at the lowest put call ratio that we've seen since about March of 2022. But you're also at roughly the ceiling of the put call ratio that you saw in late 2021. So not to include November and some of the euphoric period over here in November, December 2021, but instead the put call ratio over here at August, September, October 2021, we maxed out around 0.7. We're sitting at about 0.7 right now. We are at the lowest point in this ratio in now over about a year and 4 months. That's pretty bullish, and I think you're seeing a lot of that bullishness. And it does make you wonder, though, is that becoming too bullish, right? I like to be contrarian, but boy, it's starting to feel crowded again with the bulls. So, I suppose something to pay attention to as well. But then again, I guess we'll have to see as we buckle up and hold through earnings. Today, obviously, you've got some pretty big earnings. You've got Tesla. We'll be covering them live. I think that'll be quite entertaining. You had Goldman Sachs and such this morning, but most importantly, this afternoon is when we get some biggies. Tesla will be could be a potential game changer moment for Tesla, as maybe funds will finally wake up to Tesla, or they won't if the earnings come in too bad. But hey, we shall see. So, okay, I think that does it. I'm going to run over to the course member live stream. Appreciate you all being here. I'm going to go make another cup of coffee. We'll see you soon. Thank you so much. Fantastic day. Good look out.